That's why, in terms of recovering lost GDP output and getting back to pre-Hurricane Melissa levels of economic output, that could take probably longer than COVID. I mean, it could take a year or two, right? But that depends on how well we can execute and implement capital budget spending, which we have not really done very well in the last 3 to 4 years. We've always had an underspend in that area of the budget, and it doesn't really represent true savings to the government.
So I mean, so I remember seeing you, on certain interviews talk about how some of the funds will be used, and you split it up into like three different categories. You have like relief, which I believe the cat bond is supposed to be used mainly for, like that's immediately after, and you talk about recovery and then long-term reconstruction and so on.
Mhm.
How do you think we navigate each one of those steps? Because right now we're in that relief period still. It's been what, about 2 weeks since Hurricane Melissa? 2 weeks to
Mhm.
the day. So today is the 11th. We're recording on the 11th of November, right? So I'm assuming we're still in relief. Um, just paint a picture as to what those things look like. Like what is relief supposed to look like? Meaning in terms of what do we use the funds for? Then what does recovery look like? What does like reconstruction look like? Yeah.
Right. So those three distinct periods are just meant to illustrate, the cost requirements for getting back to total reconstruction. So, in this immediate period, it could be up to 6 months. We're talking about providing people with relief, but not all of it. So some of it must go to initial reconstruction. So we're talking about the immediate period. Now, why I emphasize immediacy and initial in this context is because these are resources that we would not ordinarily have had. We would have had to reconfigure, recalibrate the budget, which takes time, and that is even if you have space, because no, you won't. Right? Revenues are going to plummet because of that fall in GDP. So you won't have those revenues. So you need something right now. So that's what I have been trying to make. Whatever it is that you want to do right now, whether you want to put poles in the ground and have some concrete filling in somewhere, or just doing regular reconstruction, paying for relief items, paying for some construction items, fixing a few roofs here and there. Those are all things that can be done. It's just that it's no for the short term period while revenues are down, that gives you some space, right? That you would not have had because this thing now has wiped out your space to respond immediately. So that is the whole purpose. You can use it for anything, in the sense that the monies are fungible, right? There's no restriction on how it can be spent. So you can give people a little relief physically here and there, buy them a few items. You can rehabilitate a few things. You can start reconstruction. But ultimate reconstruction and full and total rebuild, will now happen when the fiscal dynamics of the country change. So if we expect to have, for example, a V-shaped recovery, then it means after the quarter, which is this quarter, October to December, we will now see it falling by 8 to 13% of GDP. Then hopefully every succeeding quarter after that will have a higher GDP growth rate than the one before it. So, and then until you get to pre-Melissa levels of output, and with inflation expected to be higher, then there is also the potential for revenue overperformance, right? Because then after that, when inflation declines back to its 4 to 6% range, then the scope for revenue overperformance is limited. So while revenues overperforming the
Can
initial,
you break that down for us, for the just for the viewers? Like, why is inflation expected to go up right now?
right? So because the productive capacity of the economy has been attenuated, it's been weakened, it has fallen completely off, and we've seen that with some agricultural prices as well.
Hmm.
That also has implications on monetary policy, because monetary policy is still tight. It's at 5.75%. I mean, you both and the community listening and everybody wants interest rates to fall down. Sad to say that that might not happen. In fact, the reverse might now happen. We have seen where equities have sold off because people want to increase their
Mm-hmm.
liquidity, which was completely predictable. And we also have to take into consideration that the influx of imports that will now come in, both for relief items as well as for food, since production is going to go down, might now also wipe out our current account surplus. So we have been running a current account surplus for the last 3 years, and given that exports now will also fall, then raising interest rates may potentially have to be a policy option in order to stave off Jamaican dollar depreciation. So, it's a confluence of factors that is anticipated to happen on the horizon. It requires very careful management. The BOJ definitely will want to preserve price stability, which is their mandate. So, anything geared towards that, as well as trying to reduce that you know, the differential between us and the US so that the rate does not depreciate too sharply, right? Because that has other implications. Like that will mean that the foreign dollar denominated debt will now go up. And, I think if you go by 1% depreciation, then foreign dollar denominated debt goes up by around 14 million US. So these are all things. Debt to GDP is projected to rise. We're going to have a total macroeconomic reset. And, um, you know, that's just something that we have to prepare for. But inflation itself, no. I don't want to make a prediction in terms of what it might be. At the height of COVID, it reached 11, 12%, but it will certainly go above the 4 to 6% range. Um, the Bank of Jamaica had already predicted that for the remainder of this year, it would have been below the range. It has been below the range for the last 3 months.
Mm-hmm.
Um, you know, and I think that is more because of the tight monetary environment. You have both, analyzed listed companies and their financials. You see P&Ls. You see that a lot of companies are squeezed in terms of their
Yeah.
profits, and the stock exchange has been down for based on the 5 years data that you can see going back. Both the financial index is down. I'm sure other indices are down. The main index has been down, even though it has stabilized a little bit, but it's not quite at pre-COVID levels. It was
True.
more robust. So people have understandably gotten a little skittish. People don't want to expand. They don't have the capital to sort of you know, um, pursue the activities that they had planned, and now they're going to have to pivot. This environment of further elevated interest rates, particularly now among a global inflationary environment where you can't predict what the American president is going to do in terms of tariff and trade policy. So,
Mm-hmm.
we're living in a different world. It's different than it was prior to 2020. It has been 6 years, basically, and we just have to adjust to this new normal. It is not going to go back to what it was up to 2019, and just navigating these shocks and these crises as best as we can is going to take a lot of effort.